The trader told me, "Yes, we bought 1,000,000 shares of those the other day. Yes, we bought 2,000 shares of those the other day." So straight away I know he doesn't know a single thing about trade risk size. Cost of the trade is often completely confused for risk per trade, which is priced in dollars, and the precision stop has issued a buy signal and the stop is at 45. How do you decide how many shares to buy? As was discussed in the previous video, doing the opposite of what losing traders do is generally regarded as a winning idea. Signal issued here, 800 pence, and the stop is at 860 pence. How do you know how many shares to go short of? So in this cell A2 you can type in your intended risk per trade. I can promise you losing traders do not employ the techniques highlighted in this video. Therefore it might be worthwhile. Hello everybody. This Excel spreadsheet is available for download on my website, and it's got facilities for English stocks in pence, American or European stocks in euros or dollars, cryptos, and also spread betting. So you can easily calculate your risk per trade by using the formulas here. It's very simple maths. To use this formula you need to know your risk per trade. So as a general yardstick, you can take the value of your equity divided by 100. So you're risking 1% a trade, and in this example risk per trade is $1,000. So we've got an entry price given by the precision stop at $48 and the stop's at $45. We can work out very simply using this formula. Stop loss at 45. If you can't see very well, there's a little gear down here somewhere on YouTube where you can adjust the resolution. You set it to HD maximum and you should be able to see these numbers. So entry at 48, stop at 45, points risked is $3, number of shares 333 shares, and it's rounded so it doesn't exceed 1,000, so this is 999. Going back to the point at the introduction, if someone always deals in 1,000 or 2,000 or 500 every time, you know they're not using this formula. So you can see from this table that if the stop is very tight, all these entry prices are 48 by the way, the stop is $half away, you can buy $96,000 worth of stock, still risking 1,000. Disclaimer, if it gaps through your stop it's gonna hurt, because that is almost 100% of the value of your $100,000 account. So it's very important to decide what is your maximum cost. So there's two numbers to consider. The purpose of this video is just to highlight how risk per trade changes by adjusting the stop. So if this was a really volatile crypto, so 28 points trailing stop, you could only buy 35, $1,680 worth, but you're still risking the same. Whereas if your stop was 47.5, you can buy $96,000 worth. And you can see these numbers getting smaller and smaller as the stop distance gets further and further away. So this is called trade risk sizing or position sizing. This is another example. This time it's a short trade and the stock is priced in euros. Precision stop has given a sell signal. The entry price 38.2 euros. The stop is at 53.82 euros. Please note it's not required to rush out and buy precision stop. You can put the stop wherever you think it's appropriate. It's often a good idea to use like a 50 period ATR, 5 ATRs, so we're roughly 2, so that would make it 48.2. So we'll put these numbers into the spreadsheet and we'll see what it tells us. So using the Excel sheet, the short entry price is here, and these are all the different stops, so you can see the value changing. So if the stop is very tight at 40, we've got a short position of $21,201. If we've got a wide stop here, 66, we can only sell 35 shares and we've got a position of 1,337. but the risk is always $1,000 or just under because of the rounding. So the precision stop has suggested 53.82, giving us 999.68 risk and a deal size of 2,444 euros. This rather odd diagram is to give you a visual impression of the general idea. The squares are the same size on the right and they're different shapes and sizes on the left. So using this technique, if a trader is sentient enough to understand these points, it will naturally iron out the bumps in equity curves as its volatility adjusted. A losing trader will ask, why don't you risk more when you've got a good one? That's what losing traders do. They ask stupid questions. Stupid because nobody knows the future. That's why the concept is to risk the same amount in every trade. My apologies for the beeping a little while ago. It's my early warning indicator. So methods of employment are twofold, or maybe you could find three. The concepts of using equity divided by 100 is nothing new, but the point is that it's a dynamic. So every time you do a calculation, you need to know what your equity is now, not what it was at the beginning. So if you started with 100 grand and it went to 80 grand and you're risking 1%, you'd be risking $800 a trade instead of 1,000. So it's a dynamic thing, but there's more than one way of doing it. So you can take the core equity plus open trade profit, which is more risky and it's aggressive. A more conservative, safe method is to use your core equity divided by 100. So that's the value of your equity if you get stopped out on all your trades. And if you've got thousands of trades on and you're highly geared, it's much safer to use the latter method. This is a very deep and a very wide subject. Small changes can make huge differences. So if you've got enough ability to do simulations across portfolios, it's a very